Welcome to the GPS to Your Business Success podcast. This week's topic is selling your business and legally not paying any tax on the gain. What's that, you say? No tax? Come on, that's got to be too good to be true. It isn't too good to be true. There are some rules you have to follow, but it's one of the lesser known provisions in the tax code that you want to make sure you know about because you're talking about savings that are generational wealth creating. In simple terms, you could sell your stock of your company, have a gain of up to $10 million, or in some cases more, and legally have no federal capital gains taxes. What's more, most states also recognize some form of this law. If you're not living in California or Minnesota or Pennsylvania, and a few other states we'll talk about, you will have some kind of state tax savings as well. So let me talk to you about this in this week's podcast. I think you'll find it very interesting. Whether you're just starting out, whether you're thinking about doing a business, whether you're well on the road to success here and you're looking at least at the beginning stages of selling down the road, there's a 5-year hold period involved. So while there are some exceptions to that rule, you need to plan for this ahead of time. So good to think about it now. I'm your host, Nick Papakyrikos. I'm a CPA, business advisor, and wealth manager with Papakyrikos CPA, a 8-person firm located in Boston, Mass. For the last 37 years, we've been helping businesses, individuals, and families reach their full financial potential all across America. And while we work with a wide range of clients, we have a particular concentration in auto repair shops, auto body shops, real estate businesses, investors, consultants, and high net worth, or those who will soon be high net worth individuals. We talk about the topics you want to know about. We explain them in easy to understand and interesting ways. We help move you closer to reaching your business and financial goals, one step and one episode at a time. I will give you the legal disclaimer that we're required to give. The information provided in this podcast has been gathered from sources that we deem to be reliable, and they represent our general opinion regarding the topics discussed. Before taking action on the information provided herein, you should speak with us about how this information applies to your specific situation and the pros and cons of any of the actions you might take. Well, now that we have that out of the way, let me just briefly thank our sponsors. Steer CRM is the platform that helps auto repair shops acquire new customers and drives existing customers back to the shop for regular maintenance and service. And of course, Papakyrikos CPAs, your partners in success. We offer proactive advice you can understand and want to follow, fixed fee billing. We are the GPS to your business success, which is where the name of this podcast comes from. All right, with that out of the way, let's talk about qualified small business stock. This is one of these provisions in the tax law that has been around long enough that I remember when it first came out. And when it first came out, it was no big deal because you could use the expression, give with one hand, take away with the other. But the way the law worked, there wasn't really any great incentive to use it. So we're talking August of 1993, this became law. And over the last 30 or so years, every time new tax legislation is enacted, which seems like almost every year, little changes would be inserted into this provision because people realize that, well, we wanted to encourage the creation of small businesses and jobs, but nobody seems to be jumping at the opportunity to use this rule. So they would sweeten it and sweeten it and sweeten it until they eventually came to a point, I'd say about 10 years ago, where they came up with these basic rules. If you form your company after a certain date, I believe it's 2014, and you hold it for a minimum of 5 years, and you meet certain other requirements, each shareholder can have a gain of $10 million, or in some cases more, be tax-free. And if those shares may be owned by your children as well, each of those children can have a $10 million tax-free gain. So if you're in a growing business, a business that's rolling right now, and you think at some point down the line you want to sell, be it to private equity, be it to somebody else, you'd like to know about this rule and to decide whether it makes sense for you. Not only does it help you minimize your tax bill, it also allows other provisions that will help you keep and retain good employees and also make them wealthy as well at no cost to you virtually. So let's talk about the typical business owner this might apply to. You can't do this if you are a restaurant, a hotel, or a motel. You can't do it if you're involved in what we first refer to as personal service businesses like lawyers, accountants, doctors. But if you are something other than those, for example, an auto repair shop, an auto body shop, a technology startup, wholesale business, retail, manufacturing, you may be eligible to do this. What are some of the basic rules? Well, your company has to be organized as a corporation, and that corporation has to be what we refer to as a C corporation. In other words, it's not a subchapter S corporation. Subchapter S corporation, you may know, the income or losses pass through to the shareholders personally, and in most cases, the corporation itself doesn't have much, if any, tax liability. With a C corp, the corporation retains all the income and expenses, it pays the taxes, and the only way money comes out to the owners is either through payroll, rent if they happen to own some of the property, or dividends. There's lots of pros and cons to those things, but in the context of this qualified small business stock provision, we'll talk about the important ones here. In addition to being a C corporation, and if you aren't a C corporation, you're an S corporation now, you can fix that. There are some steps to do so, so don't stop listening if you are an S corporation right now. You must be incorporated in the U.S. This has to be an active business, so it can't be something that's holding things. It has to be an operational business, which most people who are starting and growing a business would meet. It can't have assets that are worth more than $50 million before or after the issuance of the stock. Now, you may say, I wish I had $50 million of assets. And for most small businesses that are looking at this from the beginning, that's probably going to be the case. But think of it this way. You have started your business, and along the way, you've grown, you've had some success, maybe you've opened a couple of locations. There might be some valuations out there that would say that if you sold your company right now, you would get somewhere in that neighborhood. Probably not most people, but for really successful businesses, yes. So you want to do this sooner than later. You don't want to wait until you're at $25 million in assets or $30 million in assets. And by assets, I mean the value of the company, not that you purchased $50 million or $30 million of items. Other requirements is the person who owns the stock, the person who will get this tax-free gain, has to have received it directly from the company. That means the original founders of the company issued their shares. Anybody, an employee, for example, who might be part of an employee stock purchase plan, gets their shares directly from the company. Any investors who want to buy into the company give the company cash in exchange for shares. So as you could imagine, this is also a structure that will attract investors. So for many small businesses, as they grow, they become in need of capital. There are many venture capital companies out there who would find their business model interesting, want to invest in it and help it grow. If you are in this qualified small business C Corp structure, you make yourself that much more attractive, because who doesn't like to invest in something that can generate tax-free capital gains? But you might say, Nick, I've heard that S corporations are the way to go for small businesses, and C corps really aren't that great. Well, that's true to a certain extent, and it's true in probably many contexts, but let me just explain it a little bit. It's true that if you're a subchapter S corporation, the shareholders are taxed personally, which means they're taxed at the individual tax rates. And that's what we refer to sometimes as one level of taxation. You're taxed on the income once, that's it. That's the good part. With a C corporation, the corporation pays the taxes, and whatever is left after taxes sits in the company account and can't go to the shareholders unless it's paid out for reasonable compensation, which means it's just a deductible expense of the business, or it's paid out as a dividend. If it's paid as a dividend, the corporation can't deduct that dividend as an expense. So it's taking money that's already been taxed and it's writing a check to the shareholders. The shareholders now pick that up as income themselves as a dividend, same as they would a dividend of Microsoft or Apple or anybody else. So that's what they refer to sometimes as double taxation. Now, what's happened in the last several years, though, is the tax rates for C corporations have dropped significantly. As we sit here today in 2024, there's a flat 21% federal tax rate on C corporation profits. Compare that to a subchapter S corporation where the individual shareholders are paying tax. If they're making a few $100,000 of income or more, a lot of that income is being taxed at 37% for federal tax purposes. And over and above that, they're paying state taxes at whatever their state tax rate is. And if you live in any one of the high tax states, that's a fairly big number. So why would I want to go and do this C Corp, or what are the benefits of having the C Corp? Well, one of the under-discussed benefits of the C Corp structure here is that if you are growing, let's say you have an auto repair shop and you have a formula that seems to work like clockwork, you feel at some point, I could just open up shops anywhere I want. And if I use this formula that I have, I'm going to just be printing money after a while. That's great. Well, you're going to have to acquire and open those shops one way or the other. That's going to require some capital, whether you buy an existing shop, whether you buy a closed down shop, or whether you lease some space that is empty, that is in need of a location for a new auto shop. It's going to require capital. Well, if you're operating as an S corporation in your business, you've probably been taking money out, at least to pay the taxes, and then to reward yourself for the risk you've taken and to reap some of the profits. Well, every time you want to start a new shop, you've got to reach back into your pocket, put more money into the new one. So you're always putting money in and putting it out. I suggest that if you are at the point where you're making money, you're not missing any meals, and you have not terribly many money concerns, my suggestion would be, if your plan is to grow this business, this chain of businesses, this group of businesses, to a point where it's large enough to sell and hopefully achieve multi-generational wealth for your family, your children, your grandchildren, for as many generations as you can imagine, then I might say, all right, I'm going to go with the C corporation structure. I will pay taxes on my profits, but a lot less than I would have paid personally. So now I have more money left in the company because I didn't have to pay 37% in taxes. I paid 21%. If you happen to be operating in a state with no state corporate income tax, Texas, Florida, Ohio, there's no state income tax to pay. So now your business, which is creating income and profits, that you are paying state income taxes on and personal income taxes on in the S corporation format, now you're paying probably lower rates in the state sense, and you're paying less taxes in the federal sense. So if you had $1 million of income, you pay 21% in federal taxes, that's $210,000. You have all the rest sitting around to leave in the company and to invest and buy new locations. You'd have a little less if there's a state tax. The point is, a lot of money sitting in the corporation. Granted, you can't take it out, but there are legitimate ways where you can take it out. As I said, reasonable compensation. The corporation deducts it. You pick it up as income. If you own the properties that the businesses operate in, that reasonable rent can be deducted. You can structure it in a way so that you're certainly pulling out sufficient income to meet whatever your needs are. But again, the goal here is to say, looking long term, how do I hit a grand slam here? How do I grow this business into what it can be, sell it for as much money as the world will offer me, and minimize that tax bill? If that's the model that looks attractive to you, this C corporation structure is really, really worth looking at. Now, as I said, you have the shares. This works because the company that wants to buy your business is going to walk in and say, okay, for Mr. Smith Corporation or Miss Smith Corporation, we are going to buy your shares of stock. So you have the Smith Auto Repair chain, and it owns 7 locations in and around the state of Florida, we'll say. Well, the private equity group or the larger competitor that wants to buy those shares or buy those locations is going to pay you personally for your shares. They're going to give you an offer that says, we'll pay you $75 per share or $3 million per share, whatever the deal is. And every shareholder will be paid that amount of money. Now, if you have employees that are part of a stock ownership plan, they may have different classes of shares, which is something you can only have with a C corporation. You can structure it in a way so that when you accept the deal, you make the lion's share of the money because you've taken the risk and you deserve it. But if you're inclined to say, look, part of what helped me get where I was is the key employees I had, and you want to set up a system where, A, while you're growing, they see the golden handcuffs that will allow them to reach pretty significant amounts of wealth by staying with you. You structure the deal so that their class of shares receive some amount of money that you think is fair. They're not going to want to leave. You're going to make more money than you could possibly imagine. And all of you are very likely going to qualify for this tax-free capital gain as long as you've owned the shares for at least 5 years. Again, you see why it's important to do this early and to set it up in the right way. But you just don't find opportunities like this every day. As I said, there are some states that don't recognize this rule. They're sometimes we call the usual suspects. California doesn't recognize it. New Jersey doesn't. Pennsylvania does not. Minnesota does not. Alabama does not. And Puerto Rico does not. Other states have variations. Here in Massachusetts, there's a lower rate that applies. Point is, if all you had to do was pay the state tax, I think you'd walk away thinking, I had a pretty good deal. Those are the big points on this qualified small business stock. The important point is for you to know about it early on. We went through a situation with a client we obtained later on in the process of their existence. They went through and converted from an S corporation to a C corporation. Oftentimes what you will find is startups are big on losses. You're spending a lot of money investing in the company. And even though converting that S corp to a C corp might trigger some gain, a lot of times you have losses sitting around that offset that. So it doesn't mean that it's going to cost you a lot of money. The point here is it's an important consideration that you should know about. It's been on the chopping block for a while with Congress. It came within 2 votes of being eliminated 3 or 4 years ago. But we hope, and this is the typical case with legislative changes, that should this ever change in the future, that companies that are already qualified in this manner will be grandfathered in. You don't know. There's no crystal ball that I have or anybody else has where tax legislation will go, but all we can do is make the choices based on the rules as they are and make the best choice for our financial futures. So that's it for this topic. Check out the podcast page for some useful links and tools related to today's podcast. If you have a topic you'd like to hear about, please email us at podcast@papakyrikoscpa.com. That's Papakyrikos, just like it sounds, cpa.com. From time to time, we will draw one lucky winner from all the emails we received since the last drawing to win a $25 gift card. Remember, if your financial car is already moving steadily down the road to success, I hope we've helped move you a little further today and given you some information you'll find useful. But if you feel like the engine is hesitating a bit, maybe you hit a pothole in the road, or maybe you took a detour someplace down the road and you're not sure where the road you're on right now is going to take you, you're in the right place today. We are the GPS to your business success, and we would love to help you get back on track and to move you forward to your business and financial goals, whatever they are. So as you go about your affairs this week, remember, a journey of even 1,000 miles begins with a single step. Have a great week. We'll see you next week. Goodbye. We'd like to thank Auto Shop Answers. Auto Shop Answers is an industry-leading automotive repair shop training program taught by industry veteran Todd Hayes, Chief Operating Officer of Adams Automotive in Houston. It focuses on helping all repair shop owners understand the concept behind the $1 million per month shop known as Adams Automotive in Houston. The course is conducted monthly in Houston with limited seating. If you'd like to learn how to make your shop as profitable as can be, this is a class you don't want to miss. Registration is now open for upcoming classes, which are September 28th and 29th, October 18th and 21st, and November 15th and to the 18th. You can find out about the courses and the program at autoshopanswers.com. Again, that's autoshopanswers.com.